Bloomberg News.
Our first guest this morning, everybody, correctly predicted the 1987 stock market crash. In his most recent newsletter, he says the government stimulus plan will be a disaster. Marc Faber is editor and publisher of the Gloom, Boom, and Doom Report. He comes to us from Hong Kong on this Friday morning. Marc, good morning.
Yes, good morning to you.
So,
how are you?
I'm doing well. You know, we'll get to the stimulus plan in a moment because I know you have some thoughts on that. I do want to ask you about what Eric was just talking about. What do you make of potentially maybe the next step to help out banks to really emphasize guarantees of toxic assets over proposals to create that so-called bad bank to buy up all the toxic assets? Is this a better idea? I know you've been a critic of all this government intervention.
Well, I'm not sure. I think probably the best would have been to nationalize the banks and let the shareholder, the bondholders and the preference shareholders lose essentially their ownership and their money, and then kind of sort out the problems, or let the banks go bankrupt like the automobile companies, but then guarantee the bank depositors. In other words, if you have a savings deposit at the bank, that you would be made good by the government, and the other assets that would be then left to the market.
Marc, hold on a second. You said it's better for either nationalization or for these firms, these financial firms, these banks to go bankrupt. How come?
Well, I have a totally different plan than what the government is offering in the United States. Basically what the government is doing, because don't forget they are closely connected to the financial sector through all kinds of nice little relationships, what I would do is I would take the good assets out of the banks and take over these banks by the government, and the toxic assets you throw at the banks, their shareholders, their preference shareholders and the bondholders. So the government ends up with good assets, and the shareholders and the risk takers who bought the bonds and the preference shares, they end up with the garbage. And they can then do with the garbage whatever they want. But that will be a market-based solution. Whereas at the present time, the solution is you take out the bad assets, you give it to the government. Who is the government? The taxpayer. All right. Well,
how can you guarantee that that would be a better solution?
You will pay tax for that.
No, I know. I'm a taxpayer. I'm well aware of that. How can you, though, be so sure, Marc, that that would be a better plan? I mean, what historically tells you that that's the better route to go?
Well, but I have to tell you, in economics, that's one of the problems. You're never 100% sure. But I can tell you that the current crisis, the economic crisis and the financial crisis, is a direct consequence of continuous U.S. government intervention into the economy through fiscal and monetary policies that have been designed to never have a recession and to combat recession. And what has happened, if you never have a recession, it's like someone who never sleeps. You need some sleep, a resting period, and then you recover. And that has happened in the economy in the U.S. They never had a resting period.
But, Marc, would we have recovered from a resting period where potentially Citigroup, Bear Stearns, Lehman, did go bankrupt? All of these firms we let just kind of go down. Would we recover from something like that, or how long would it take?
Well, actually, I tell you, if they went under, the crisis would be much shorter than with government interventions. It may be very steep and very painful in a brief period of time, but the market would very quickly adjust and prices would collapse and some buyers would come in and take over the essentially distressed assets. This way, with the stimulus package the government is proposing, especially the spending package, I think the depression will last longer, and the government that is largely unproductive will continue to grow at the expense of the private sector and crowd out the private sector.
You know, Marc, I want to take you back to something you mentioned, and you were referring to Hank Paulson and I guess being very friendly with Wall Street. Do you think if we had had a Treasury Secretary who hadn't been formerly at Goldman Sachs that this would have been played out differently?
Well, I think that if I look at the SEC, if I look at the New York Fed, if I look at the Federal Reserve under Mr. Greenspan, there has always been an extremely close and cozy relationship between the regulators and between the government agencies. and precisely government-related enterprise like Fannie Mae and Freddie Mac and Wall Street, because Wall Street is, of course, a big contributor to GDP and to the lobbyists.
Mark, we're just talking about the stimulus plan. Bill Gross is saying that the government needs to spend trillions of dollars. You're laughing. So that's a big mistake in your view?
Well, I like Bill Gross. I think he's a very nice man, very successful, gives a lot of money to charity. But we have totally different economic views. I think if the government spends that kind of money in stimulus, it will have some dire consequences. First of all, a little noticed event has been that the 30-year yield on government bonds has risen now from 2.5% in late December to 3.6%. So if you have a stimulus package and your fiscal deficits go up dramatically, eventually you will end up with higher interest rates and higher inflation rates down the road.
But Mark, isn't that okay? Because if we get the economy going, well, that's maybe okay. I mean, especially if you look at the way the economy is right now.
That is, I love it. That may be okay. I tell you, there is no free lunch. Someone has to pay. And the problem arose because we have too much debt, not because we have too little debt. And now debt is being contracting, which is necessary, and savings rates in the US should go up. But no, the government doesn't let that happen. The government wants to re-stimulate and create on top of an enormous debt burden additional debts. That's the problem. And that additional debt will not be spent very productively because it's spent by the government and not by the private sector.
But the
so in general, I would
Mark,
say if the...
Mark, the private sector got 30 seconds here. Private sector doesn't seem to want to spend right now.
Well, the best the government could do is a massive tax cut. Then at least it goes into the private sector and people can decide what they want to do. So it's more of a market-based solution than what is now being proposed.
But didn't Bush do a lot of tax cuts and it didn't seem to do much? I mean, look at where we are right now.
Yes, but the problem did not arise because of the tax cuts. The problem arose because of continuous government intervention that Mr. Bill Gross is proposing.
I can't let you go without asking you about strategy. I mean, gold, from what I understand, you say that one day the price of gold will be higher than the Dow Industrials. Is that really so?
Yes, I think so. I mean, it's been now higher. It went higher than the price of the S&P 500. And obviously, the way I see economic policies in the world and in particular in the US is print money. If it doesn't work, print more, build up fiscal deficits. And as you said, somewhere, somehow it will all work out in future. But I don't believe it will work out because I'd have to repeat once again and very clearly that all your viewers understand that it is not a failure of the free market that brought about the crisis. It is continuous intervention by the government with fiscal and especially monetary measures that have brought the crisis about. And now the same people that brought the crisis about want to solve it with more intervention.
And I will tell you, I've got people already, viewers emailing me saying you do have it right, so I'm going to send that out to you. But I got to get back to gold. So does gold go up to $8,000 an ounce, or does the Dow come down to 1,000? Which one is it?
Well, I mean, if Mr. Bernanke continues to pursue monetary policies based on the Zimbabwe philosophy of monetary policy, namely to print, then the Dow will go to 1 trillion and gold will go to 1 trillion or higher. And if you have tight monetary policies and the Dow drops to 4,000, maybe gold will be at 4,000 as well.
All right. I also got to ask you about tech stocks because I know you've talked about it on our air that you like names like Cisco, Oracle, Yahoo, Microsoft. From my understanding is that you think that these stocks could double, maybe even triple, and then go down to zero?
Oh, I don't think they'll go to zero. But in general, I have to stress this, the average lifetime of a company is 30 years. And I mean, when I started to work in 1969, the leading technology companies were companies like Digital and Boros and so forth and so on. Most of them have disappeared. And so a lot of companies disappear over time. But I believe that I recently visited with Intel. I was invited at a seminar, and I like the CEO very much. He's a very bright guy, and the people that work there are very bright and motivated people. And I think that Intel stock will do better than long-term U.S. government bonds. And I think a package of Oracle, Microsoft, Intel, and Cisco will outperform U.S. government bonds by a wide margin over the next 5 to 10 years.
All right. We're going to have to leave it on that note. Never have enough time with you, but always good to get time with you, Marc. Thank you so much and have a great weekend.
Yes, you too. Bye-bye.
All right. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP